Most people enter the stock market with a singular obsession: price. They chase the green, fear the red, and spend their days trying to outsmart a volatile ticker symbol. But what if you stopped looking at stocks as gambling chips and started seeing them as productive businesses? The core philosophy, dividend investing for beginners, is simple but transformative. Do not invest for price. Invest for income. It's about shifting from emotional reactions to systematic evaluation, and from short-term excitement to long-term compounding. In this video, we're not going to talk about get-rich-quick schemes. Instead, we're going to break down the 10 essential pillars of building a dividend portfolio, a system where your money works harder than you do. Whether you're just starting or looking for a more disciplined approach to wealth, this 15-minute guide will give you the roadmap to financial independence through consistent cash flow. Chapter 1: What is dividend investing? To build a successful portfolio, we must first define the engine that drives it, the dividend. At its simplest level, a dividend is a distribution of corporate profits. When a company earns more money than it needs to operate, it has a choice: keep the cash or share it with the people who own the company. As a dividend investor, you are that owner. This leads us to the ownership mindset. Most people look at the stock market as a speculative playground, a place to buy a ticker symbol today and hope to sell it to someone else for a higher price tomorrow. That is speculation. Dividend investing is different. It turns you into a real business owner. You aren't just betting on a price chart, you are acquiring a piece of a productive enterprise. Whether the market is up or down, as long as that business remains profitable, you receive a share of those profits in the form of passive income. We must also understand the distinction between income and growth. While growth investing focuses on the future potential of a stock's price, dividend investing prioritizes immediate and consistent cash flow. It's the difference between waiting for a tree to grow so you can cut it down for lumber, versus planting an orchard that provides you with fruit every single season. The core lesson of Chapter 1 is simple: if you want long-term wealth, you must stop thinking like a trader and start thinking like an owner. Chapter 2: How dividend work. Understanding how dividends work is like understanding the engine of a car. You don't just turn the key, you need to know the mechanics under the hood. First, let's talk about the mechanics. Dividends don't appear out of thin air. They are a deliberate choice by a company's board of directors to share a portion of the net profits with you. It is the ultimate sign of a company's financial health and its commitment to its shareholders. However, receiving that cash requires precision. You must master the 4 key dates. The declaration date, when the company announces the dividend amount. The ex-dividend date, this is the most important date. You must own the stock before this date to be eligible for the payment. The record date, when the company officially wraps up the list of shareholders. The payment date, the day the cash actually hits your account. To judge if a dividend is worth your investment, we use 2 key metrics. The first is dividend yield. This is the annual dividend payment divided by the stock price. Think of it as the interest rate on your investment. But remember, as the stock price goes down, the yield goes up, which can sometimes be a warning sign rather than a gift. The second is the payout ratio. This tells us what percentage of earnings a company is paying out as dividends. If a company earns $1 and pays out 60 cents, they have very little room for error. A sustainable payout ratio is the safety net of your income stream. As the book wisely reminds us, a dividend is only as strong as the earnings that support it. Without profit, a dividend is just a ticking time bomb. Chapter 3: Dividend yield versus dividend growth. Now that we understand the mechanics, we must address the most dangerous temptation for any beginner: the yield trap. It's easy to be blinded by a stock offering a 10% or 15% dividend yield. It looks like a bargain, but in the stock market, if something looks too good to be true, it usually is. A sky-high yield is often a warning sign, a red flag that the company's stock price has crashed. Trouble. If you chase these numbers, you aren't investing, you are catching a falling knife. You might get a few checks now, but you will watch your original capital vanish. On the other side of the spectrum, we have the growth factor. This is the real engine of wealth. A company might start with a modest 2% or 3% yield, but if they have a track record of increasing that payout every single year, something magical happens. This growth is a signal of a robust, competitive business with rising profits. Over a decade, a growing dividend will far outperform a stagnant high-yield stock because of the compounding effect on your initial investment. As the book warns us, chasing yield without understanding risk is one of the fastest ways to lose income. The core lesson of Chapter 3 is this: don't just look at what a company pays today. Look at their ability to pay you even more tomorrow. Chapter 4: The Power of Compounding. If dividend investing is the engine, then compounding is the fuel that makes it unstoppable. Often called the eighth wonder of the world, compounding doesn't require high speed, it requires absolute consistency. It's what we call the snowball effect. Think of a small snowball at the top of a hill. As it rolls, it picks up more snow, which makes it larger, allowing it to pick up even more snow. In your portfolio, this happens through DRIP's dividend reinvestment plans. Instead of taking your dividends as cash to spend, a DRIP automatically uses that money to buy more shares of the same stock. Now, you own more shares, which pay you even more dividends, which buy you even more shares. This cycle creates exponential growth, increasing your ownership and your income without you ever having to reach back into your own pocket. But there is one critical ingredient: time. Time is your greatest asset. The math is simple: the earlier you start, the less heavy lifting your capital has to do. Compounding is backloaded, meaning the most dramatic gains happen in the final years. While most people quit because they don't see results in month 3, the dividend investor wins because they are focused on year 30. The core lesson of Chapter 4 is this: wealth is not a sprint, it is a marathon where time does most of the running for you. Chapter 5: Evaluating dividend stocks, the filter. Picking a dividend stock isn't about guessing, it's about auditing. To separate the elite companies from the risky ones, we use what the book calls the 5 pillars. This is your filter to ensure a dividend is not just high, but safe. Pillar 1: Earnings consistency. A company cannot pay you if it doesn't make money. We look for businesses with a proven track record of stable or growing profits over at least 5 to 10 years. If earnings are a roller coaster, your dividends will be too. Pillar 2: Free cash flow. Earnings are an accounting figure, but cash flow is reality. A company needs actual cold hard cash left over after paying its bills to send you a check. Always ensure the dividend is backed by real cash, not just paper profits. Pillar 3: Sustainable payout ratios. This is the ultimate safety metric. It tells us what percentage of earnings is being paid out. If a company earns $1 and pays out 90 cents, they are redlining. We prefer companies that keep enough profit to reinvest in themselves while still paying you. Pillar 4: Debt management. In a financial crisis, debt is a dividend killer. A company drowning in interest payments will always cut your dividend first to pay the bank. We look for clean balance sheets and manageable debt levels. Pillar 5: Competitive advantage, or the moat. Does the company have something that prevents competitors from stealing its profits? Whether it's a powerful brand, a patent, or a massive scale, a moat ensures the business stays profitable and your dividends stay safe for decades. The core lesson of Chapter 5 is simple: a safe dividend is paid from actual profits, not empty promises. Chapter 6: Building a dividend portfolio. Knowing how to pick a single stock is a skill, but knowing how to build a portfolio is a strategy. In Chapter 6, we move from being a stock picker to becoming a portfolio architect. The first rule of architecture is stability, which comes through diversification. You've heard the phrase, don't put all your eggs in one basket. In dividend investing, this means spreading your capital across different sectors like technology, healthcare, and consumer goods. If one industry faces a downturn, your other sectors act as a bulkhead, keeping your total income stream afloat. Next, we must find the perfect balance. A truly resilient portfolio combines two types of assets: high-yield stocks for immediate, heavy income, and dividend growth stocks for future wealth. Think of it as a relay race. The high-yield stocks give you the lead now, while the growth stocks ensure you have the stamina to finish the race decades later. Finally, we execute the strategy. Building a portfolio isn't a one-day event, it is a gradual process. You don't need a fortune to start, you just need a target. By setting clear income goals and consistently adding to your positions, you move from owning stocks to owning a system. As the book reminds us, diversification protects income the same way it protects capital. It isn't just about reducing risk, it's about ensuring that no single event can stop your progress toward freedom. Chapter 7: Risk Management. In the world of investing, risk isn't just about market crashes, it's about being unprepared. To protect your income, you must first learn how to identify warning signs. Dividends don't disappear overnight, they leave a paper trail. Before a company cuts its dividend, you will almost always see a declining trend in profits and an unsustainably high payout ratio. By keeping a close eye on quarterly earnings, you can spot these red flags and exit a position before the damage is done. Protecting your capital is just as important as growing it. However, the greatest risk isn't the market, it's you. This brings us to emotional discipline. The stock market is a device for transferring money from the impatient to the patient. Prices will fluctuate, and corrections will happen. But remember, a dip in stock price is only a loss if you sell. For a dividend investor, a market downturn is often a sale, an opportunity to buy more income at a lower price. Your discipline must be permanent, even when market volatility is temporary. The core lesson of Chapter 7 is profound. Your behavior and your ability to remain calm will determine your long-term results far more than your ability to time the market. In the end, the person who can control their emotions wins the game. Chapter 8: Financial Independence Through Income. We often talk about wealth, but what does it actually mean? In Chapter 8, we define it through the freedom formula. Instead of chasing an abstract millions of dollars goal, we focus on a simple calculation: your annual living expenses. When your annual dividend income covers those expenses, you are officially free. To get there, you must make a shift in metric. Stop measuring your success by your net worth, which fluctuates with every market whim. Instead, measure your success by your monthly passive income. Net worth is vanity, cash flow is sanity. When you focus on the income, the market's daily noise loses its power over you. The core lesson of Chapter 8 is this: financial independence doesn't start when you have a big bank account, it starts when your money works harder for you than you do for it. Chapter 9: Common Investment Mistakes. Before we reach the finish line, we need a rigorous reality check. In the world of investing, your greatest enemy is often not the market's volatility, but the operational errors you commit out of impatience. The first trap is yield chasing. It is the siren song of high percentages that blinds investors to deteriorating business fundamentals. A 10% yield is meaningless if the company is burning through its capital to pay it. Second is the silent wealth killer, overtrading. Every time you click sell in a panic or buy on a whim, you are not just paying fees and taxes, you are interrupting the miracle of compounding. Finally, we have the fear trap. Most investors exit the theater at the first sign of smoke, missing the grand finale when the market eventually recovers. In finance, excitement is a luxury you cannot afford. The core lesson: your process is your protection. Emotional investing is a guaranteed loss. Practical analysis. The yield illusion. Distinguish between a value play and a yield trap. If the payout ratio is over 100%, the dividend is a ticking time bomb. The friction cost. A portfolio that is traded 20 times a year will almost always underperform a static one due to commissions and tax drag. The reaction gap. Professional investors build a pre-flight checklist. If the reason you bought the stock hasn't changed, the price drop is an opportunity, not a reason to flee. Chapter 10: The Long-Term Mindset. As we conclude our journey through this roadmap, we must embrace the final piece of the puzzle: thinking in decades. Wealth isn't built in days or months. It is the result of thousands of small, disciplined decisions made over years. Dividend investing is not a race, it is the system. It is a sustainable, repeatable machine that grows stronger every time you reinvest. Don't get distracted by the next big thing. Stick to the system, focus on income growth, and trust the process of consistent reinvestment. Our final message is simple: the best time to plant a tree was 20 years ago. The second best time is today. Build your system, stay patient, and let time do the rest. Building a sustainable income stream is one of the most rewarding journeys you can take, but it requires the right roadmap. If today's summary sparked a new perspective on your financial future, I highly recommend reading the full version of Dividend Investing for Beginners. Chapter 11: The Roadmap to Mastery. We have now navigated through the 5 systematic pillars of dividend investing, from filtering for quality to building your psychological shield. But remember, information alone is not power, it is only potential. A true cash factory is not built by chance, but through the consistent discipline of an owner, not a trader. This journey is not about timing the market for a momentary thrill, it is about mastering your cash flow for a lifetime of financial freedom. The core lesson: wealth is not built by luck. This engineered through systematic discipline. 3 practical analysis. The long game: time in the market always beats timing the market. Cash flow focus: prioritize the growth of your dividend stream over daily price fluctuations. Ownership mindset: treat every share as a partnership in a high-quality business. Book showcase: all these principles, and the step-by-step mechanics to apply them, are analyzed in depth in the book, Dividend Investing for Beginners. It is your essential blueprint for building a lasting financial legacy. Grab your copy today on Amazon and start engineering your future. The book dives much deeper into the specific stock filters and tax strategies we couldn't cover today. You can find the direct link to the book on Amazon in the description below and in the pinned comment. Don't just watch the market, own a piece of it. Click the link, grab your copy, and start building your dividend empire today. If you found value in this video, please hit the like button, subscribe for more systematic investing guides, and let me know in the comments, which dividend stock are you watching right now?